Wealth isn't just about money. It's about the life you build and the legacy you leave behind. Welcome to Money Sense, where we've spent over 30 years helping people make confident decisions that reflect their values and build lasting impact. Welcome to Money Sense. Hi, I'm Karen Ellenbecker, founder and senior wealth advisor at Ellenbecker Investment Group. Today, my guest is Mike Roth, and Mike is the founder of Stark Investments, and we're going to talk about how to unpack the pressures from the geopolitical platform to inflation and how inflation is shaping the start of 2026. And Mike, I can say welcome to the show, but I think I figured out that we've been doing the show together for over 25 years.
Yeah, the days are long and the years are short.
I mean, it's just absolutely amazing to me how much time has passed. And I still remember, and it's such a fond memory of mine of meeting with you, and the market was crazy. Things were going on. And I remember saying, Mike, can we sit down and can you help me figure out how to keep my clients safe? How
Your clients are always in good hands with you and your team, Karen's. But to the extent I can help, I'm always happy to do so.
Well, and you did because you sat down with me and you helped me to figure out how to do the balanced portfolios and how to incorporate that safety ladder of the bonds and really spend some time with me. And I've never forgotten that. So I really feel like I just want to thank you publicly here for being such a good friend, being a friend of mine, being a friend of Ellenbecker, and being a friend to our clients and, of course, our listeners, because you've been doing the radio show all these years. And one of the things that has always come up is that when you talk about the markets and when you talk about what's going on in this world, you have this ability to talk in a way that people can hear you. And I think, that really is a gift because in our industry, everybody wants to talk over everybody's heads and confuse it. And you keep it simple. So in the idea of keeping it simple, give us a little bit of unpack, as it said, where we are today and some of the things that we've been experiencing.
Sure. Well, I appreciate the compliment. I'll try to deliver on that. I think it's useful to view where we are right now by stepping back and remembering where we were coming into the year. So coming into the year, I think the consensus was we were looking at what's known as a structural bull market. And that's just a fancy way of saying that people felt, boy, we have a lot of tailwinds coming out of 2025. The market was up 18%. The market had been up in a similar vein for the past 3 years. So a lot of momentum coming into the year. We were looking at a scenario with easier monetary policy, or another way of looking at it, the feeling was inflation was coming down and the Fed was going to start cutting rates more aggressively, which is very positive for the market because that makes borrowing cheaper. The Trump administration was very clear that they wanted to run the economy hot. So they were going to be very accommodating in terms of fiscal policy. So we had the one big beautiful bill, which was cutting taxes. They were providing tax incentives for manufacturing, construction, et cetera. There was a lot of deregulation going on. So I think the feeling was we have positive monetary policy, positive fiscal policy. Borrowing in general was going to be easier. We are going to continue to see AI capital expenditures driving the economy and the market. We're going to start to see AI productivity coming into the market. Tariffs were going to start coming off because deals were being made. So again, very positive, very tailwind oriented. So when you look at the consensus prediction coming into the year, they felt the economy was going to grow at a very nice clip, around 2 to 2.5%. They thought the market, the S&P, was going to look at something in the range of 10 to 12% total returns. And that was not being driven by what had been driving the market in the prior couple of years. You look at the prior couple of years, there was a lot of what's known as really expansion of the multiple. Not so much being earnings driven, but people's just expectation. Oh yeah, there's, earnings coming. So we're willing to pay more for these stocks. Coming into this year, the feeling was, okay, now it's real. We're going to see real earnings driving these stocks. And that was on the back of the view that margins were going to be some of the highest profit margins in history, like 14%. So all positive, all metrics looking very good. Beneath the hood, I think the feeling was we're going to start seeing some differentiation, particularly in AI space. So the Mag 7, that had been so popularized in the prior couple of years, the feeling was there's going to be a rotation away from a very narrow Mag 7 mentality to what they would you might call the broader 500, that people are going to start looking more broadly beyond simply a few AI names to small cap, mid cap value plays that had been somewhat overlooked during the Mag 7 craze. Also, I think even in AI space, the feeling was you're going to see a rotation away from simply the big infrastructure builders to more the adopters, companies that had taken AI and been able to turn it into real productivity gains. So that was the table being set coming into the year. So what do we get? As the saying goes, man plans and God laughs. Because the reality is, as we're sitting here now, and it really depends, and we're going to get into this in a little more detail, when you look at it, but the market at the end of March has been looking down around 4 or 5%. And it really depends which day you're looking at and what headline you're looking at. But it came off, and it started coming off really in February. If you go back and you say, well, where was the market prior to everything going on in Iran? So that would have been literally February 27th on a Friday. Well, the market was actually pretty flat. And the reason for that we'll get into, because people really have focused on, oh my gosh, the market has come off based upon what's been going on with the Iranian situation. But the market was already somewhat coming off, or at least flat-ish, going into that. So what happened? Well, what happened to all those rosy prognostications? Well, I would say really three different factors. One was there was a big change in AI. And we're going to talk about AI as sort of a specific subject. But in terms of what happened in the market between January and March, really a dramatic flip in thinking about AI. Up to this point, AI has been all unicorns and rainbows, right? Oh my gosh, AI is going to be fantastic, and it is fantastic. But what happened was AI companies, the bigger AI companies, started borrowing a lot of money, and the reason they were taking on a lot of debt was that they wanted to make some big investments. They were planning on data centers, a lot of huge expenditures. And that was a bit of a wake-up call for investors. They went, whoa, that's a lot of money that you've raised and a lot of money you're planning on spending. And it was sort of this wake-up call that, maybe we should take a more careful look at how this is really going to get monetized. So all this spending, is it really going to be something that you're going to be able to monetize, or are you just simply lighting cash on fire? I mean, it's what they ask of every company. But I think up until this point, AI had received a bit of a pass, and there was much more focus on that. Secondly, I think AI went from being this is going to be fantastic for everybody, to the realization that AI is a disruptor. And there was a moment when Anthropic, which has the Claude models, came out and displayed this particular set of tools, which would allow companies to build AI agents. And so the big difference here was that this was not AI where you put in a prompt and you get information. This was AI that would go out and do stuff for your company. And there was this epiphany, again, just like the epiphany that, wow, they're spending a lot of money. There's this epiphany that, wow, this could actually be pretty bad news for software companies, because why do I need to buy a financial software package or Salesforce or Oracle if I can simply use these AI tools to build my own apps and build my own, essentially, software? So all of a sudden, the whole AI space got essentially turned a little bit upside down, and people started realizing, boy, maybe these high valuations are a little too high. And people started coming out of AI names. And of course, there had been such an overconcentration, and people had been employing so much leverage that there was sort of a big overreaction on the downside. So AI suddenly became a driver of volatility and, more importantly, a driver of the market coming off, even in February before anything happened in Iran. So you had that. Secondly, I think people have been pretty optimistic that we're going to continue to see inflation come down. Inflation had come down to about the mid 2% range, so 2.5%. And that's pretty close to the Fed's target. And of course, we're going to be undergoing a change in leadership at the Fed. So there were a lot of interest rate cuts priced in to the market. And then in February, again, there was a shock. And the shock was a report on producer price inflation, the PPI, so-called PPI. So this is wholesale prices as opposed to consumer prices. And the market had been expecting a 0.3% increase. And what came through was a 0.7% increase. Now, that may not seem a lot, but when the market is expecting 0.3 and they get 0.7, there was a bit of a freak out. People went, whoa, that was hot, way hotter than we expected. The overall year over year went from 2.9% to 3.4% inflation in producer prices. And why that's so critical is that ultimately producer prices get passed through to consumers. So all of a sudden it was, wow, we really have to reevaluate how many Fed rate cuts we're going to get. So people have been talking about 4 or 5 rate cuts, and all of a sudden it's like, wow, we might not get more than 1, maybe 2 if we're lucky. That impacts the market because suddenly monetary policy, which we identified earlier as a tailwind, may not be much of a tailwind. We may not get much in terms of relief on borrowing costs, and that's going to affect growth. And so that was a shock to the market. So you take just those factors alone, the AI sort of change in thinking and the inflation surprise, and that alone took the market to flat at the end of February. And then we had the big boom, which was we wake up on Saturday morning on February 28th, and, we're bombing Iran. It was the Israelis. We're not going to get into the politics of that and whether that was a good thing or a bad thing, but the reality was it was happening. And the immediate response was an oil shock. The reason there was an oil shock is that a huge amount of the world's oil goes through what's known as the Strait of Hormuz. And the Strait of Hormuz is this little narrow body of water, which represents one of the great choke points in oil transportation in the world. And it's just to the south of Iran. And 20% of the world's oil and 30% of liquid natural gas goes through the strait. And because it's this little narrow body of water, it's real easy for the Iranians to essentially disrupt all transportation through the strait. Their cheap drones can essentially cause havoc with tankers. And that's exactly what happened. So all of a sudden, oil spikes 40 to 50%. So it had been around, $60, $70 a barrel. And suddenly we're looking at $100 plus per barrel. And what that translates to for your average person is the price of gasoline is up $1. Price of diesel goes from $3 and change to over $5. And it's not so much affecting Americans because we're very fortunate. We don't really actually get a lot of oil from the Middle East or natural gas. We actually export natural gas and oil. But for Asia and Europe, this is a shock to their entire system. I mean, they are in deep water here, so to speak. And so the oil shock now is reverberating through the markets, the equity markets. And the reason is that this now represents potentially a huge spike in inflation because obviously everything is connected to energy prices. And if energy prices were to be at these high levels, now you're looking at rate increases, not rate cuts from the Fed because they're going to have to deal with this inflationary shock. Overall, just higher volatility in the markets because there's a huge amount of uncertainty now as to what's going to happen at the macro level. So that took us down from flat at the end of February to where we are currently, which is down, as I said, somewhere between 4 and 5%, depending on the day you're talking. That's sort of the quick look at how we got to where we are now. Essentially, it's been 3 major factors: the AI sort of rethinking, the inflation shock, and the oil shock. So what were the sort of big factors? And we've alluded to at least 2 of them. So I want to dive a little bit deeper into what's going on with Iran. We're also going to dive a little bit deeper into AI. And then I also want to talk about something that may be less familiar to the listeners, which is private credit.
Well, let's take a quick break and then we'll come right back. And one of the things, as you were talking about AI, is we were talking about the companies and the expansion that they've done. But I'd also like if you could just touch on what is AI going to do for the average investor who is looking at investing and the research and all the different things that are happening within just the whole financial arena as AI is really entering all these different markets in different ways. And I find it so interesting, but also it seems confusing in its own way, too. And with that, we'll be right back.
Want to keep building wealth that aligns with your values? New episodes of Money Sense drop weekly. Subscribe now and continue learning how your money, your choices, and your life can work together.
Today, I'm joined by Mike Roth, who is the founder of Stark Investments, and we're looking at the geopolitics and inflation, and we've talked a lot about Iran. And I know that, Mike, you said you're going to talk more about Iran and AI and private credit. And I know for us, I was talking to Julie today, and we were saying that right now it seems like our clients are feeling okay, even though it's been a little bit bumpy and a little bit crazy. People still seem to have a lot of confidence. And so we're not getting a ton of calls and a ton of panics. But when you bring all this together, I mean, how can investors, how can they view what's going on?
Well, to answer your prior question about I mean, you can't or overstate, I guess, what a revolutionary period we're living through right now. Having a lot of gray hair, we've lived through a few. I'll speak for myself, and this is as remarkable as anything we've ever seen in our lifetimes. And I think obviously people will look back and say, yes, this is one of the great turning points in history. And what AI does for your average investor is it really and people obviously, particularly if they're not technically oriented, may feel intimidated by everything about AI and all. I'll never be able to understand it, but it's getting more and more dead simple. And they're getting better and better at allowing people who have no really sophistication in technical space to simply put questions to these models and get any information that you would need to make informed investment decisions. You want to know about what's going on right now with the market, and give me a detailed breakdown of why the market is where it is and what the outlook is or anything. You don't have to listen to me. You can actually access that information quite readily, and you're going to be shocked if you're not already familiar with these models and how detailed and how fast and how comprehensive they are in providing information. So the information's there and is actually more accessible than ever. It's probably the most accessible way you can get information in the history of mankind right now. And that may sound like an exaggeration, but it isn't. So it's a great tool for anybody just to sort of get a better sense of what's going on and help them talk to people like you and help translate what you're trying to tell them into something they can understand. So that's sort of how AI fits in the bigger picture. In terms of how investors should be looking at the things I'm going to talk about in a moment, I think that to the extent that they are so far sort of taking it somewhat in stride, I'm sure they're concerned because they've seen some losses in the portfolio. But actually, the downturn in March has been quite orderly. It's not a crash. It's been about 2% a week, and it's had bounces when it seems warranted. But I think there's an underlying feeling that this is not going to be an escalated, widespread situation, that is going to be de-escalated at some point. Clearly, the Iranians are somewhat on the back foot. They've had their military decimated. Probably 90% of their military assets have been destroyed. That last 10% is still causing problems in the Strait of Hormuz, as we discussed, because they can utilize cheap drones to essentially damage and destroy tankers. And it's not as easy for our forces to shoot down every one of these little drones. You don't want to necessarily use a $1 million missile to shoot down a $50,000 drone, but we continue to degrade their military assets. And I think the feeling is, okay, there is an off-ramp here. So off-ramp is sort of the word of the day. Everybody's looking for what the off-ramp's going to be. And in fact, if you're following just the news recently, President Trump had said essentially, if you keep attacking ships in the Strait of Hormuz, we're really going to destroy your energy infrastructure, which up to this point, they really haven't hit it all that hard because we don't really want to destroy their energy infrastructure. We would rather make a deal with them. That's the way Trump operates, right? He wants to make a deal. But he said, if you don't stop doing it in 48 hours, we're going to come and destroy all your energy infrastructure. So the market was sort of going like, oh my gosh, is this really going to happen? And then he came out and said, hey, I think, we're talking. So I'm going to hold off for 5 days here while we're talking. I think we can get a deal done. And so the market had a huge relief rally. So I think that investor confidence that there is going to be some sort of de-escalation right now is probably well-founded, but it's completely unpredictable. I mean, you're talking about so many different variables, and you can tune into talking heads all day long with different views on how this might go or could go. But I think the feeling is that because of the damage the Iranians have taken, the search is on for a face-saving off-ramp, so to speak. So that's sort of the background. So let's dive into what I would call the fog of war. And that's a term that really goes back to a fellow named Karl von Clausewitz, who was a Prussian military strategist way back in the 1800s. And what he did was he coined this metaphor, talking about the uncertainty and the misinformation and essentially the inability to really make good decisions because of all the uncertainty surrounding war. And over time, that morphed into this phrase, the fog of war. And what we have right now is that on steroids. So we have fog from the war permeating the financial area because, as I said, from day to day, it's really hard to figure out what's going on and which way this is going to go. Because obviously, Trump's whole MO is to make a lot of noise, carry the big stick, but ultimately wants to do a deal. The Iranians, they respond by bombastically saying, well, we're going to destroy you, or we want reparation, all this kind of stuff. So you got a lot of different moving parts. But ultimately, you're looking at a situation where it's been a controlled pullback in the markets. The markets right now recognize the oil shock and where oil prices are, but the feeling is that that's not going to last long term. That's sort of where the market is. That's why it hasn't been a crash. It hasn't been a super dramatic pullback. I think that ultimately the market upside that people may have thought we would see coming into the year is going to be more capped. I think that's what people think. Yeah, it's going to be a good year, but not a super great year. Obviously, the trend, though, is still embedded with the belief that we still have a structural bull market. We still have an earnings-driven situation, but it's obviously a lot murkier now because of what's been going on with the price of oil and all the uncertainty about what the off-ramp is going to look like. So are we going to see higher inflation and slower growth? Perhaps, but it's still not clear. And that's why the market it's down some, but not dramatically. And of course, we're now in a situation where headlines are just driving the market up and down. So it's a whipsaw all the time. But ultimately, I think the market right now is cautiously expecting that there will be some sort of resolution sooner rather than later. So we'll circle back to this when we talk about the outlook going forward.
Do you see any major changes in the interest rates and because of the war and some of that? I mean, often that's the case.
That's the billion-dollar question, Karen. I think right now people are thinking, well, it's not so much we're going to see rates going up, unless, of course, we continue to see $100 plus oil. I think people are now more concerned that, well, we're just not going to have as many cuts as we were hoping for. So inflation could be stubborn and not go down, but sort of just be sticking around where it is right now, which would make it more difficult for the Fed to justify cutting. But the wild card here is oil. And if oil prices continue to remain high or go higher, then it's a completely different picture. Then we're looking at potential rate increases, which would, of course, be a big drag on the market and a big drag on economic growth in our country. So moving from the fog of war, let's look at the fog surrounding AI, because as we discussed, I think that the big flip has been AI being this driver of the market to being both a tailwind and a headwind, and really looking at much more sort of a two-speed market. So the focus now is on winners and losers, much more scrutiny of what's going to be going on and who ultimately is going to be able to monetize all this spending. So winners, I think, are expected to be, companies that have been able to articulate sort of a clear path to here's the money we're spending, here are the data centers, et cetera, and this is what it's going to allow us to do, and we're going to really be able to sort of drive profitability with this. So you're probably still looking at, the large companies like the Alphabets, the Google type companies as being in the winner's circle. Semiconductors, infrastructure plays, I still think that those are going to be considered to be winners. Also, people who are the adopters, people who've been companies that can show, hey, we've been able to take AI and really turn it into productivity gains. We're saving money, we're increasing profitability by using AI. Everybody has said that, oh yeah, we're going to do that. But the people who have been actually able to do that are going to be considered winners. Among the losers, as I alluded to earlier, are software companies. I mean, they're just getting hammered in the S&P sub-indices, and the software services indice is down 30%. I mean, there are headlines about Salesforce and some of these other, it's called actually SaaS, software as services. And the SaaS space is getting really hammered because there's this whole question around, well, at best, your profitability is going to get hurt. At worst, your whole business model is blown up because if people can actually replicate your software themselves, well, duh, I mean, you're in trouble. So I think that in terms of AI as a space, that has caused a lot of volatility. Obviously, it was a very overcrowded trade coming into the year. Everybody was into the trade. A lot of people were into it with leverage. So when the market starts selling off and AI starts selling off, well, all that gets amplified on the downside. So if the overcrowding goes to people heading for the exits in a crowded way, people unwinding their leverage trades in AI, and that has exaggerated the downside move in AI. And that, as well as the rotation that we already spoke about, is people going from just pure infrastructure plays to adopter plays, companies that have been able to adopt AI. So I think that's been a big story. And even though it's overshadowed right now by what's been going on in Iran, ultimately will continue to be a big story throughout the rest of the year.
Mike, I think about my father-in-law was a watchmaker. And the old-fashioned watchmaker, literally. And then Timex watch came along. And
Yep.
Guess what? Nobody wanted to go to my father-in-law to have their watches fixed. They wanted batteries to go into watches. And that's really literally how fast this is changing. And I see so many other industries as well, where it's just in business one day and out of business because of some of the things that AI can actually do. And so it made me curious. That was when you were talking about it. That's what I thought about my poor father-in-law. And it happened to my dad, who owned a gas station, that all of a sudden he was fixing cars and pretty soon everything was computerized. And it seemed like it happened overnight when his business completely changed. And I think that's what we're seeing right now.
That is spot on, Karen. I think that on the one hand, you might say, well, duh. Everybody said AI is going to change everything, but it wasn't until recently that they actually sort of made that into a concrete thought. And they said, oh, wait a second, that if I really follow that thought through, yeah, I think, and particularly in software space. And as I said, some of the new tools coming out really open people's eyes. Wow, you can do that with these tools. And boy, that's bad news for some of these other companies.
I think we'll take a quick break. Mike, we'll take a quick break. And when we come back, we'll get into the private credit.
Money Sense is brought to you by Ellenbecker Investment Group. If you're looking for a trusted partner or ready to elevate your financial plan, you're in the right place. With multiple Better Business Bureau Torch Awards for ethics and integrity, Ellenbecker combines expertise with a team member you can trust. Meet our advisors and explore financial resources at ellenbecker.com.
Welcome to Money Sense. My guest today is Mike Roth. He is also the founder of Stark Investments, and Mike and I have been friends for a very long time. And one of my favorite shows is always working with Mike because, Mike, you have this way of making such sense of it and also making it fun to learn. So I really appreciate that. And we were talking about AI and all the things that are changing, and that kind of segued us into private credit and some of the things that are also going on. And then I would like to take a little bit of time to sort of look at what does that crystal ball say?
Sure. Absolutely. Well, it's a great segue from AI to private credit, and I'll explain why in a moment. First, a lot of your listeners may not be familiar with private credit. So, private credit is just non-bank lending to companies. And it really came into more prominence after the 2008-2009 period, where banks obviously took a lot of losses on loans. There was a pullback by the banks in lending, and into that vacuum came private funds. And initially, these funds were focused on making loans to companies. Usually, these were sort of mid-level to lower-level companies, you might say. Not the best credits in the world, but they were eager to borrow, and they were finding the banks not interested in lending to them because they weren't the greatest credits in the world. So these private funds began forming, and they began taking in a lot of institutional money. And what they were doing was they were saying, look, we have the expertise to make good loans to these lower credit companies. We can get higher yields on those loans, so they're very attractive. Yes, they're illiquid, but we can also get bespoke terms. So we can essentially craft the terms of these loans much more. And that was the whole pitch. And so from those early beginnings in 08, 09, it has grown into a $3 trillion, that's trillion dollar
Wow.
plus asset class. It's still somewhat below the radar, or at least has been until recently. And what happened is that as these funds grew, they pulled in more and more institutional capital. They ironically became customers of the banks. So they began borrowing from the banks. So the banks essentially were both competitors of these funds as well as clients. These were clients of the banks. And as they grew and, as I said, blossomed into this $3 trillion industry, they also said, we should allow mom and pop investors to invest in private credit. So, yeah, okay. A good idea, probably from their perspective. I don't know about the mom and pops, but in any event, you began seeing public vehicles, ETFs, publicly traded funds that were private credit. Now, there's a bit of a mismatch there, which is really the crux of what's going on right now, which is that these funds would provide a degree of liquidity that really wasn't matched with the underlying loans, because these loans by definition are illiquid loans. Okay, so that's the sort of background to private credit. And what happened is that private credit had essentially a couple of unfortunate events in the last several months. First of all, private credit is very concentrated in, wait for it, software company loans. 30% of their portfolios are in software companies, okay? So you can see where this is going. But it really goes back to September and the months following September. There were two very high-profile bankruptcies, one involving an auto parts manufacturer, one of the largest in the world, called First Brands, another involving a subprime auto loan lender called Tricolor. And I mean, these were big bankruptcies. First Brands had about $5 billion in debt. Tricolor had about $1 billion in debt. And it turned out that there was massive fraud involved in each case. Double counting loans that were used as collateral, phantom inventory, really, really bad stuff. And so there was a lot of publicity around these huge bankruptcies, and private credit was heavily exposed to it. So all of a sudden, investors in private credit were saying like, whoa, what kind of underwriting are you doing on these loans? And how do you manage the collateral, and how do you keep track of this? Because it looks like you guys were really asleep at the switch on this. All of a sudden, a lot of doubts were being raised as to essentially the lending practices in private credit. And that was sort of the first okay, or the herd is starting to get restless here. Investors are starting to get a little nervous. And then we had what we just described was this all of a sudden big turndown in software companies. As I said, the software company index is down 30%. And investors are looking at this and going like, we know you guys have a huge amount of exposure in software credit. And now you're taking write-downs on these loans because these software companies are getting hammered. What you started seeing, and this is where the headlines started coming in, there was, I guess the polite phrase would be redemption pressure. The old phrase would be a run on the bank. I mean, 10, 11% of the
Wow.
funds are being pulled out. So you're talking about a $25 billion fund, and 10% plus of the people want their money out. Now, these funds are structured in a way because, they know that they don't have that kind of liquidity. They can't simply come up with, 10% of the assets under management. They have illiquid loans. So they have a mechanism built into their funds that allow them to, the phrase is gate, quote unquote, gate their funds, which is another way of saying they can limit the amount of money you can take out. So you may come in and say, I want my money. And they're going to look at you and say, well, if you read the fine print on the document, we're going to limit it to 5%. So, that's it. You're getting maybe, you individual investor are getting maybe 40% because we're putting an overall gate on redemptions in the fund. So what happens when you put a gate on redemptions in the fund? Well, you get more redemptions, obviously, right? Because now
Right.
people are getting nervous. I don't want to be left holding the bag. So this might not have been a problem. Institutional investors are usually more sophisticated and have more staying power. But remember, these private credit funds wanted to go retail. They wanted to have more mom and pop investors, and mom and pop investors want out of Dodge because they're very concerned. They're very nervous. So the banks potentially are taking losses through their exposure to these private credit funds. The banks themselves, I'd say about 10% of their loans are to these same software companies. So they're getting sort of a double hammer. They're losing money on the loans they made directly. They're also losing money on the loans they made to the private credit funds. So this is more by way of pointing out that, yes, you're going to see these headlines. This is what's going on. Is it a big systemic risk? I would say no, not right now. It's pretty narrow. There's obviously a lot of angst when you get all these redemptions and people can't get their money back, and that makes for good headlines. But when you look at the broader credit markets, I would say at the moment, it's more something to keep your eye on as opposed to a big systemic risk. It obviously amplifies risk, it amplifies volatility, but probably is not something that the credit markets overall are going to seize up over.
Mike, when you talk about all these things that, are affecting the markets, and I wonder if you could just give a quick overview as to how is it really affecting my clients in terms of, we talked a little bit about gasoline, electric bills, food. What is it going to do to people's lifestyle right now? What does that look like for this year? And of course, when we talk about investing with our clients, we sort of build in that there's going to be volatility, that's going to be up, it's going to be down. And we try to protect the income that a client needs on an annual basis, regardless of what's happening with the market. But that isn't always true for everyone. And I think a lot of clients are just looking at the headlines and they're wondering, okay, how is this going to affect me?
Sure. I think there's two things we should focus on. One is sort of, as you pointed out, everyday life, and then their investment portfolios. So from an everyday life standpoint, the big wild card here, as we discussed previously, is what's going to happen with oil. If oil were to stay where it is now at this highly elevated range, which is, right around $100 a barrel, you're going to see inflation, and it's going to get passed through. And all of a sudden, people in their everyday lives are going to be paying more for gas, more for food, more for everything, because oil affects everything. Everything gets transported, in some cases manufactured on the back of it. And while we will be better off in the United States because we don't depend upon Middle East oil, it's still going to flow through because the overall global price of oil will be elevated. You won't want to be in Europe or Asia because it'll really hurt them. And that's the big question. Again, this goes to the question of de-escalation versus escalation, of containment versus a widening of the conflict. Is there an off-ramp, and how quickly do we get to it? And although oil, which is a commodity, has spiked, the markets haven't really, I think, bought into the idea that this is the new reality. I think they still think, okay, we're going to get an off-ramp. Oil prices will come down, maybe not to the $60, $70 range, but they will come down. And while we might have, some uptick in inflation, it's not going to be so severe to impact people in a severe way or cause the Fed to start to raise interest rates in reaction to it. So that's sort of where we are right now. But as I said, fog of war, this could go in a lot of different directions. But I think the consensus feeling is it's more likely to de-escalate than ramp up from here. So there's that. From an investment standpoint, I think that, people right now are looking at a different picture, as we said, now versus what we thought we were going to get coming into the market. It's still a bull market. It's still a structural bull market. So you still have that going for you. It's just not going to be the same sort of robust bull market that we had hoped for. It's going to be sort of more of a narrow market because people, as I said, are going to be focused more on, who's really going to benefit from AI. Even in AI, who's really going to be able to monetize this? So a more narrow focus. I think there's going to be a more volatility, duh, right? Because we've got all these various balls in the air right now. So it's going to be a more volatile market than people maybe anticipated. But I think still structurally, the trend is still positive. It's going to be a bumpier ride, a good ride, but a bumpier ride. And then finally, I think you're going to see people more focused in a defensive manner. They're going to be focused on higher quality opportunities. They're going to be focused on winners. For instance, as we discussed in AI space, who are the winners? And that is going to be sort of a reversal of the broadening. We thought it was going to be more of a broadening to the broad 500, but I think there's going to be actually more of a narrowing. So more volatile, narrower, focused on winners. That's what we can look for coming into, I think, the rest of the year. But there's a lot of variables at play.
What do you think about currency? And I'm just curious, and it's changing. And do you have any quick insight into that?
Well, obviously, the dollar is the beneficiary of chaos because it's considered a safe haven. And we've seen on the back of what's been going on with Iran, a strengthening of the dollar. Whether that persists or not, I think is tied directly to what direction this goes in. The dollar will weaken somewhat if the off-ramp is sooner rather than later and faster. But I think also in a world where you've had this disruption and I think the European economies and the Asian economies, it's going to take longer for them to recover from this because, again, they're so much more dependent upon Middle East oil and Middle East natural gas than we are. Our economy is going to look good. I mean, there was actually a feeling like, well, the U.S. is so rich with valuations so high, 22, 23 times earnings. There was more of a feeling that, well, maybe we should be looking in overseas markets. Now, given the hammering that these economies are likely going to be taking going forward, and then they will not bounce back as fast, my guess is that the U.S. will be the beneficiary of that, which will also help the dollar.
My guest today is Mike Roth, and he is the founder of Stark Investments, and he has been sharing his knowledge with us for a long time. Mike, thank you so much. I really appreciate it, and I hope you'll be back. There's so much more to talk about.
It's always a privilege, Karen, to talk to you and to speak to your many investors. And so, I'm happy to do it anytime. Thank you.
Thank you so much. Have a really good day, and thank you for joining us on Money Sense. We hope today's conversation made a meaningful difference in your personal and financial well-being. At Ellenbecker Investment Group, before we plan, before we advise, before we invest, we always listen. Have a great week. Bye-bye.
Thanks for listening to this episode of Money Sense, brought to you by Ellenbecker Investment Group. If you found today's conversation helpful, we encourage you to share it with a friend or family member, and be sure to subscribe wherever you listen to podcasts so you never miss an episode. At Ellenbecker Investment Group, we believe that education is the foundation of confident financial decisions. That's why we're proud to bring you insights from experienced professionals to help you build true wealth, beyond just money. Please note, this podcast is intended for general informational purposes only and does not constitute personalized financial advice. Before making any financial decisions, we recommend consulting with a qualified advisor who understands your unique situation. For more resources, visit ellenbecker.com. We'll be back soon with more insights to help you live with clarity and confidence.